What if the nest egg you've spent decades building turns into a tax bomb the moment you're gone? You've dutifully maxed out your IRAs, socked away every RMD, and even added HSAs for extra tax breaks, thinking you're handing your heirs a financial gift. But buried in the fine print of many retirement vehicles lie traps that can leave your loved ones staring at six-figure tax bills instead of a comfortable inheritance. Traditional IRAs and 401k. S may seem like the backbone of any retirement plan, but without the step-up in basis, every cent your beneficiary pulls out is taxed as ordinary income, and the new 10-year distribution rule can force lump sum withdrawals that vault heirs into the highest tax brackets. Self-employed plans like SEPs and SIMPLE IRAs only widen that trap, piling on early withdrawal penalties for non-spouse heirs who aren't prepared for the rules. Think non-qualified annuities are a safe harbor? They're tax-deferred growth flips into taxable gain on death, with beneficiaries losing the chance to spread distributions and getting stuck with immediate full income taxation. Even health savings accounts, renowned for their triple tax advantage, turn into taxable windfalls for non-spouse heirs, wiping out that hard-earned tax shield overnight. And if you rely on a 403b for 57b or a defined benefit pension, the legacy you thought you'd locked in can unravel. Death benefits treated as ordinary income, or even estate assets, survivor options that slash benefits or drag heirs into unexpected tax brackets, and no smooth 10-year payout window to soften the blow. In this video, we're exposing the 5 most common retirement accounts that can become major tax traps for your family and showing you the proactive steps you can take now, from strategic Roth conversions to updated beneficiary designations, to ensure your legacy truly goes to your heirs and not straight to the IRS. Stick around, because what you don't know about tax on death could cost your loved ones far more than you ever imagined. Traditional IRAs and 401k. Are the poster children of retirement savings, but they can become the IRS's best friends when passed on to heirs. Unlike your taxable brokerage account, where your beneficiaries get a full step-up in basis to the market value at the date of death, your tax-deferred accounts carry no such gift. Every penny your heir takes out is taxed as ordinary income, and recent legislation means they can't stretch that burden over decades. Instead, the Secure Act forces most non-spouse beneficiaries to empty the entire account within 10 years. Imagine inheriting a $500,000 IRA. Under the old stretch rules, your beneficiary might have taken out $25,000 a year, keeping them firmly in the 12 or 22% bracket. Now, they could be staring at $50,000 or $100,000 distributions in a single year, catapulting them into the 35% bracket, with up to $175,000 eaten by income tax before that money ever hits their bank account. Real stories underscore the shock. One family in Ohio watched their daughter's inheritance dwindle by more than $70,000 in just a few weeks because of the new 10-year rule, and another heir in Florida had to borrow against other assets to cover the six-figure tax liability on a lump sum withdrawal. Worse, there's no way around it. IRAs and 401k have no alternative payout options that treat distributions as principal versus growth. Even a qualified charitable distribution must be pre-death, meaning that if your beneficiary wants to pass money on to charity, they first face the full ordinary tax hit. The only defense is proactive planning, converting to a Roth IRA while you're alive, so withdrawals by heirs are tax-free, and carefully timing those conversions to dodge bracket spikes. Without that strategy, your traditional retirement accounts risk turning your legacy into a warning label. Warning: may cause massive tax bills. But the traps get deeper. When you look at business owner plans, self-employed retirement vehicles like SEP and SIMPLE IRAs can pile on both income taxes and early withdrawal penalties for heirs, turning what you thought was a business owner's bonus into a legacy headache. These plans allow generous contributions when you're still earning, but they carry the same tax-deferred rules as a traditional IRA with a twist. Non-spouse beneficiaries don't get penalty-free access until age 59 and a half. Under regular 401k or IRA, a spouse inheritor can roll assets into their own account or wait penalty-free, but a child or distant relative inheriting a SEP or simple IRA faces a 10% early withdrawal penalty on any amounts taken before they turn 59 1/2, on top of the ordinary income tax. Combine that with the Secure Act's 10-year distribution deadline, and you've got a recipe for steep compounded bills. Heirs pressed to empty the account within a decade may take large withdrawals while under penalty age, instantly sacrificing 10 cents of every dollar plus up to 37% in income tax. Real-world examples hit hard. One small business owner passed away, leaving a $300,000 SEP IRA to his daughter who was 45. She had no choice but to withdraw $30,000 a year to meet the 10-year rule. And every dollar before her 59 and a half birthday triggered the penalty, costing her an extra $3,000 per year in fines plus federal and state income taxes. The sum effectively shrank her inheritance by more than 50%. And there's no workaround. SEP and simple IRAs lack Roth options under most business structures, and they can't be folded into a spouse's retirement plan posthumously. The only real safeguard is converting some or all of your SEP or simple balance to a Roth IRA well before retirement. Managing the tax hit in lower income years so that when the plan passes to heirs, they inherit tax-free assets with no penalties. Without that step, you risk leaving your survivors not a cushion, but a tax burden they never asked for. Non-qualified annuities can look like a clever way to lock in tax-deferred growth outside of retirement accounts, but on death, they flip into a major tax liability for your beneficiaries. Here's why. Unlike IRAs, annuities aren't retirement accounts, so they don't get the same payout rules, and they offer no step-up in basis. When you die, the remaining contract value passes to your beneficiary, but the IRS treats every penny of earnings as ordinary income, not capital gains. If your annuity has doubled or tripled over the years, your heir could be hit with a massive tax bill on that entire gain portion in the year they receive it. Some annuity contracts let beneficiaries stretch distributions via a death benefit payout period, but many still require full distribution within 5 years, or even as a lump sum. That forces heirs into the highest tax brackets, often right when they're also juggling estate settlement costs. Real examples are sobering. One New York family inherited a deferred annuity valued at $600,000, only to learn that $450,000 of that was taxed as ordinary income in the year of death, resulting in nearly $200,000 in federal and state taxes before the funds moved. Worse, unlike qualified plans, annuity owners can't convert to a Roth or use a qualified charitable distribution to shield gains. The tax trap is baked into the product design. The only way around it is to layer your estate plan with disclaimers or trust arrangements that allow beneficiaries to spread annuity payouts over longer periods. But those strategies require precise drafting and can be overturned by insurers or courts. For most families, the straightforward solution is to rethink using non-qualified annuities as a legacy vehicle. Consider Roth IRAs or taxable accounts combined with tax-efficient investing instead, so that what you leave behind isn't a ticking tax bomb, but a truly usable inheritance. Health savings accounts are celebrated for their triple tax benefit. Contributions go in tax-free, growth compounds tax-free, and withdrawals for qualified medical expenses are tax-free. But that golden tax shield shatters the moment you pass, at least for non-spouse beneficiaries. When a spouse inherits an HSA, it simply rolls into their own HSA tax-free, preserving that advantage. For anyone else, children, grandchildren, friends, the entire account balance is treated as taxable income in the year of death. Imagine leaving behind a $200,000 HSA you diligently funded for decades. Your nephew or niece, excited to cover medical bills, ends up reporting that $200,000 as ordinary income on their tax return, potentially adding tens of thousands in federal and state tax liabilities before they ever spend a dime on prescriptions or doctor visits. Even worse, there's no way to stretch distributions. The full balance is taxable in one lump sum, likely vaulting them into the highest tax bracket for that year. And the irony is that the very tool designed to shield healthcare expenses can become a stealth tax trap. We've heard stories of retirees who forgot to update beneficiary designations, only to have a stepchild, even an estranged one, inherit the HSA and face a brutal tax bill. Others assume they can gift the account before death, unaware that HSAs don't allow post-death contributions or transfers. Any pre-mortem transfers are considered taxable distributions for the original owner. The only safeguard is proactive estate planning. Name your spouse as primary beneficiary whenever possible. And if that's not an option, consider spending down or converting the HSA funds to cover medical expenses in your final years. Alternatively, you might donate HSA funds to a qualified charity through your will, avoiding the tax hit entirely. Otherwise, you risk burdening loved ones with a hefty tax surprise on an account you thought was a lasting legacy. Deferred compensation plans like 403, BS and 457, BS, and even traditional defined benefit pensions can seem like rock-solid legacies, but heirs often discover they're laden with tax rules and payout quirks that can vaporize significant value. With 403B and 457B accounts, the blessing of tax deferral comes with the same inheritance headache as IRAs. No step-up in basis, so beneficiaries must include every distribution, whether from contributions or growth, as ordinary income. And unlike IRAs, some 403B plans don't offer Roth conversion options, trapping retirees in a tax-deferred silo that heirs can't escape. The Secure Act's 10-year payout rule applies here, too, forcing large, accelerated distributions that vault beneficiaries into top brackets. Imagine inheriting a $400,000 403B and watching the new owner face $100,000 plus taxable withdrawals in each of 4 years, at marginal rates exceeding 37%, while also losing out on credits phased out at higher incomes. Defined benefit pensions carry their own surprises. Some plans offer lump sum death benefits, but those are taxed as income and often fully pulled into the decedent's estate for estate tax purposes. Survivorship options may sound protective, say a 50% spouse benefit, but come at the cost of permanently reduced lifetime payments and little flexibility for the next generation. And if your employer's plan isn't union-backed or multi-employer, the payout options for heirs can be extremely limited. Either a one-time lump sum or a short-term pop-up annuity that ceases payment shortly after the beneficiary's death, offering no way to stretch benefits over a child's lifetime. Beyond income tax, these plans can trigger state inheritance or estate taxes, depending on where the plan is held and the beneficiary's residence. Some states tax retirement benefits differently, with 457B distributions treated more harshly than other retirement income. Without careful planning to designate the right beneficiary, spouse versus trust versus individual, the default choices can steer payouts into disfavored categories that generate both income and estate tax liabilities. The key takeaway: these workhorse retirement vehicles aren't automatic gifts on death. They require intentional beneficiary strategies, potential Roth conversions, or even splitting balances across different plan types to optimize tax treatment. Otherwise, you risk leaving your loved ones with little more than a tax bill on your legacy, rather than the security you intended. Your retirement vehicles might feel like a fortified vault, but without careful planning, they can become tax traps that spring shut the moment you're gone, leaving your heirs with far less than you intended. Traditional IRAs and 401k hand ordinary income tax bills to beneficiaries with no step-up in basis and force accelerated tenure, withdrawals that catapult heirs into the highest brackets. SEP and SIMPLE IRAs layer on a 10% penalty for non-spouse beneficiaries under 59.5, turning a business owner's nest egg into a twice-tax penalty zone. Non-qualified annuities look straightforward in life, but flip to full ordinary income taxation on death, often requiring lump sum payouts that leave heirs gasping at a six-figure liability. HSAs shine with triple tax advantages during your lifetime, only to treat non-spouse beneficiaries as windfall income, taxable all at once. And 403(b) for 57(b) and defined benefit pensions may carry neither Roth options nor stretch payouts, adding estate tax exposure, mandatory lump sums, or steeply curtailed survivor benefits that further shrink what your family receives. The common thread is stark. These accounts all share a veneer of tax efficiency that dissolves at death, trading lifetime deferral for a legacy of steep, immediate taxation. But there is hope and a path to honor your intentions. First, audit every beneficiary designation and update it to reflect your current wishes, including contingent and primary choices. Second, explore strategic Roth conversions in low-income years to shift tax liabilities off your heirs. Third, consider spending down or gifting HSA balances for qualifying medical expenses before death, preserving that triple tax benefit. Fourth, review pension payout options. Weigh permanent reductions for survivor benefits against the tax impact of lump sum death payments. Finally, enlist an estate tax professional to model your legacy under both income tax and estate tax regimes, and consider trusts or disclaimers that can stretch distributions or shelter assets. Your life's work deserves to support your loved ones, not the IRS. By shining a light on these 5 hidden tax pitfalls and taking proactive steps now, you can transform a potential after-death nightmare into a smooth, tax-efficient transfer, ensuring that your legacy truly goes where it belongs.